As promised, let's get to these industrials. So, Scott, we had that terrible manufacturing number yesterday, right? Coming in at like 50.9, sure it's over 50, so it means growth, but just barely. And it seems like the industrials as a whole have been just really breaking down the last couple weeks. Do you think that signifies something really bad for the market, say, for the next 3-6 months out?
I think it does, because these are stocks that investors love to own.
Right.
These are the big name companies that people think are safe. And we haven't spoken about them on the show in the past few months because they haven't been leading the market. They've been lagging the market. And now as the market starts to roll over, they're starting to get weaker and look technically worse. So you have to take a look at these things, because if you're still long there and you're not out, you need to have some lines in the sand and have some stops for a better entry down the road.
But on the flip side, I do have to say, I wonder if the sell-off we've seen, especially say in a Caterpillar over the last week, is overdone. I mean, if you look at their quarter, right, revenue grew in all of its regions by double digits. The company guided higher for the year. Caterpillar expects Bucyrus will add about $2 billion in sales for 2011. It's not terrible.
It wasn't terrible, but the market voted. It was down that day, and it didn't get positive. If you look at the chart here, you'll see, I think this was the earnings day. It was either here, and it gapped down, never filled the gap, and had continuation to the downside. And this stock is now holding the 200-day. It held it here. It was a great entry the last time we came into this area, and you had a big rally. I guess if you did sell, into that bad number, maybe you buy some back at this 200-day. But 97.28 to me now is going to be a big level. I want to see how it acts around here, because if there's no bounce and this starts to go lower, it's going to take the market down with it. But this is, if you're going to buy a dip, you could buy it here, but just be careful and don't buy too much.
And if you still own some and you haven't sold, well, what do you do now? You have to wait now because it's down so much?
If you bought some, I wouldn't start averaging down yet,
okay.
Because I don't want you to be in a tier 2, tier 3 in any position right now until we get a better setup in the actual markets. I don't care what the name of the company is. When the tide goes a certain way, it all goes with it.
And you have to say that the CEO on the conference call mentioned the word slow 7 times.
7 times?
Yeah, 7 times. But it doesn't mean negative growth. It just means slow, right? I mean, we have to, maybe it's just a different kind of recovery that we're looking at, different kind of growth than we were expecting.
Well, it's the new normal. Right now,
GDP
is slowing, economic numbers are slowing, everything's slowing. The question is, how's the market going to handle it? And right now, for the first time, the market is showing extreme weakness.
And then Alcoa, I mean, the interesting about Alcoa, though, it has large exposure to China. Emerging markets, which you think would be a really good thing. And last quarter increased free cash flow to $526 million. Income grew 21%. Again, the same kind of Caterpillar. All good news, right?
But that could have been news behind us. And now stocks like to look forward. And we just saw China have some negative numbers on their PMI. You look at Alcoa, this looks gross. Okay, it's now below all the moving averages right here.
You kind of can't compete with growth, right?
No, you can. And look at the support that it's at. This is at a major level. So if Alcoa starts to break below this 1452 and close below it, some guys might even make some money short here. So this is big support. It breaks 1450. You got to be very careful in Alcoa.
And what's the line in the sand for 3M? It's been, really pummeled, violent decline ever since it reported earnings.
I think you missed your line in the sand on 3M. If I looked at this chart before. I haven't looked at this chart in a while. This is even double gross. I can't believe I said double gross, but look at this. We talk about lines in the sand. This was a line in the sand for 3M. You had a few of them. This was your upper area. Once it broke, this not only broke, it gapped below. This was your area to watch against, this 90. And once it's pierced, you had to get out of there. That's why you use stops. You use a stop here. You didn't take any of this pain. And now I guess it's coming into some bigger supported 84. And if you don't own it, maybe try a little bit here. But this is leading the market lower. This chart is not healthy at all.
And GE, same kind of deal. It's been a downward trend.
GE's just been like dribbling lower. GE was above 20, everyone was all excited, and then it just turned into like a nonsense trade. And unfortunately, everyone owns GE, even like I think my parents own GE, and it's at one of those levels, okay? It's at that 18 level that goes back to last December. If it doesn't hold this, it's below the moving averages, you could see a move, down to 17. My voice cracked. 1650, and this is another line in the sand. So as you can almost see, is that we're at some really big lines in the sand, that these lines have been holding over the past few years. Every time we come into major support, this time it might break, and just be aware that that can happen in these markets. We're only about 6% off a 3-year high, so you have to be cautious.
And then my point we were talking before we started the show was then, where do you put your money? Because where is the safe sector then? If you can't go to the industrials that would be sort of levered to any kind of growth in any kind of country, where do you go? I mean, healthcare, no, because of the debt ceiling bill that will probably be passed. Consumer staples, why? When unemployment is still so bad, where do you go?
Cash. I get really upset when I see them on TV. You have to rotate from consumer staples to healthcare to this, that. You know what? buy the best stocks in the best areas at the right price. And when you're in a market correction, stay in cash. If you can handle it, be short, or just trade active trades like we do here, testing levels until there's